Okay, let's dive right into this explainer. If you've ever noticed the incredibly crisp uniform on a delivery driver, grabbed a fresh towel at the gym, or stepped on a mat in a corporate lobby, yeah, you've probably interacted with Cintas. Today, we're unpacking the absolutely massive fiscal 2026 they just reported. Now, if you follow the facilities services sector, you already know Cintas is a giant. But this latest end-of-year earnings report, it really underscores just how much of an absolute powerhouse they've become in the B2B space.
I mean, check out this top-line number. Cintas closed out fiscal 2026 with a record-breaking $11.26 billion in total revenue. We aren't just talking about a modest beat here, guys. This is a major milestone. It reflects a highly resilient business model that is somehow still capable of driving substantial top-line growth, even when the macroeconomic environment is, well, less than perfectly stable.
So here's our game plan for today. First, we'll look at the core business. Then, we'll break down these record-breaking results. Third, we're diving into margins, cash, and shareholders. Number 4, we've got to talk about the pending UniFirst acquisition. And finally, we'll look ahead to 2027.
All right, part 1, the core business, getting ready for the workday. Think about the last time you walked into a spotless office building or, grabbed a bandage from a first aid kit at work. Cintas provides the essential, everyday items that keep over 1 million businesses clean, safe, and looking their best. Their whole corporate motto is helping customers get ready for the workday. And they do this through a highly sticky service model. We're talking uniform rentals, mats, mops, towels, restroom supplies, even workplace water services. But it doesn't stop at just keeping things clean. They are deeply embedded in safety and compliance too. First aid products, eye wash stations, safety training, fire extinguisher services, the whole shebang. When a business opens its doors, Cintas is usually the invisible engine, making sure that facility is actually ready to operate.
Moving on to part 2, a record-breaking fiscal year.
Let's look at the close of the year. Just in the fourth quarter of fiscal 2026 alone, and that ended May 31st, by the way, Cintas pulled in an impressive $2.91 billion in revenue. To put that into perspective, that's an 8.9% increase from the $2.67 billion they reported in the exact same quarter last year. And if you strip out outside factors, like acquisitions and foreign currency fluctuations, meaning we're just looking at their pure core sales engine, their organic revenue growth rate for Q4 was a very healthy 8.4%.
Zooming out to the full year, the momentum is just undeniable. They jumped from $10.34 billion in 2025 to a massive $11.26 billion in 2026. That represents an 8.9% total increase and an 8.3% organic growth rate for the entire 12-month period. In a year where a lot of companies were blaming the macro environment for sluggish sales, Cintas literally charged right through it.
So where is that $11.26 billion actually coming from? The revenue mix is highly concentrated. Uniform rental and facility services is the undeniable heavyweight here, bringing in over $8.62 billion for the year. That's up 8.1%. I mean, just think about the sheer volume of laundry that requires. Millions of garments washed, repaired, and returned to thousands of locations every single week. Crazy. First aid and safety services contributed roughly $1.39 billion. And then the all-other category, which includes their fire protection services and direct sales, rounded things out with $1.25 billion. And it's worth noting that specific category grew at a very fast 11.8% clip.
For you data fans out there looking at the 12-month income statement, there's a really crucial storyline in their operating income. While revenue grew 8.9%, their operating income actually rose 10.5% to cross the $2.6 billion mark. So operating income as a percent of revenue ticked up to 23.1%. That tells us a really important story. Cintas isn't just selling more stuff, they're actually operating much more efficiently as they scale up.
All right, Section 3, Margins, Cash, and Shareholders.
The absolutely crucial point here is a 51.0% gross margin for the fourth quarter. That is an all-time high for the company. It's up 130 basis points or 1.3 percentage points from 49.7% in the same quarter last year. And for the full year, gross margin hit 50.7%, which is also an all-time record. Crossing that 50% threshold in a labor and logistics-heavy business, we're constantly running fleets of trucks and operating massive industrial laundry facilities is incredibly difficult. It points to serious pricing power and intense operational discipline.
When asked how they managed to pull this off, CEO Todd M. Schneider pointed to two main factors. He credits this margin success to the performance of what they call their employee partners and the strategic investments the company has made in technology, capacity, and talent.
Essentially, they're leveraging tech to make their routes, their laundering facilities, and their sales teams vastly more efficient. They are turning everyday operations into a highly optimized science.
And as you might guess, this immense profitability generates a staggering amount of cash. In fiscal 2026, Cintas generated $2.28 billion in operating cash flow. Even after spending $395.1 million on capital expenditures, which is about 3.5% of their revenue, just to keep the physical side of the business growing, they still had a mountain of free cash left over. So what did they do? They confidently returned a whopping $1.65 billion back to shareholders in the form of share buybacks and dividends. If you're an investor, this is exactly the kind of capital allocation you want to see.
Section 4. The UniFirst Acquisition.
Okay, let's talk about the timeline for this major strategic pivot. On June 11, 2026, UniFirst shareholders officially voted to approve the acquisition. But shortly after, both Cintas and UniFirst received what's known as a second request for additional information from the U.S. Federal Trade Commission. Now, CEO Todd Schneider did note that this kind of regulatory scrutiny was totally expected, given the sheer size of the deal. So despite the FTC request, both companies still expect this highly anticipated acquisition to officially close in the second half of calendar 2026.
To understand how this pending merger is impacting the books right now, let's look at earnings per share. For the full year, standard diluted EPS was reported at $4.91. But as we all know, mergers aren't cheap. Cintas incurred $15.1 million in transaction expenses related to the UniFirst deal this year. If we strip those one-time costs out to see the true health of the ongoing business, the adjusted diluted EPS jumps up to $4.94. That adjusted figure represents a very strong 12.3% increase over the prior year. It shows that the core business is accelerating even as they spend big money to orchestrate this massive merger.
And finally, Section 5. Looking ahead to 2027.
So, what's next? Well, Cintas is projecting yet another year of powerful growth. For fiscal 2027, they're forecasting total revenue to land somewhere between $12.10 billion on the low end and $12.25 billion on the high end. That would represent roughly 7.4% to 8.7% top-line growth over what they literally just achieved.
On the bottom line, they expect adjusted EPS to grow to between $5.36 and $5.50. Now, it is highly important to note here that this optimistic guidance is based entirely on their current organic operations. It completely excludes any potential revenue or operational impacts from the pending UniFirst acquisition, simply because the exact timing of the close is still uncertain. It also doesn't assume any other future acquisitions. However, the guidance does factor in one surprisingly simple tailwind: the calendar itself. Fiscal 2027 will literally have one more workday than fiscal 2026. Oh, and they're also expecting their interest expense to tick up slightly to $105 million, primarily due to the amortization of bridge loan financing related to getting the UniFirst deal ready.
So as we wrap up this explainer, we're left with one really compelling question to ponder. Can Cintas maintain its record-breaking momentum in the coming year, even if the UniFirst merger faces unforeseen regulatory delays? I mean, they've clearly built an incredible internal engine. But as we look to 2027, the market is definitely going to be watching closely to see if this giant can keep cleaning up or if macro pressures will finally catch up to them. Thanks so much for joining us.